Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. And the world's on fire. Good God. I can't look at this, guys. Like, my strategy is, you buy it and you hope that you guys buy it. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody, and welcome to the day after. Man, that CPI yesterday was quite crazy. I did decide I want to switch brokers after all that because I don't know. I don't know if rhythmic data is going to be better, but it really pissed me off that like there was like a great trading opportunity and the data was like frozen. So, anyways, let's come over charts and see what they did overnight, shall we? I need my daily workspace. Hold on. We can pull it up over here. Sure. Man, that's a chart of the 6J. What a dumpster fire. Whew. Okay, anyways, so treasuries had this big dip and then returned back to break even. Apparently, when we were having that big move that really screwed me over, there was a new story from the Wall Street Journal kind of suggesting that would only put them on track to do a 75 basis point hike. That being said, the market has now priced in that they'll do a full 1% hike in July. That's like almost 100% chance now that they're going to do that. So that would put us at 2.5% with the possibility of a 75 basis point hike in September, which would put us at 3.25. And right now in the yields, we're like right at 3%. So one of those things is going to give. That's where we're at in the treasuries. S&P 500 did not like it. They did recover, but overnight they have moved lower, and I don't know, man. I'm starting to find it hard to see how they escape dropping down to 3.4 or sorry 3,400. But we'll see. That's kind of my feeling where they're going. In oil continues to struggle to hold $100 a barrel. So there is these hints that the entire commodity complex is struggling because of concerns about global growth. That could help with inflation, but it's not so simple because those things take time to be reflected, and everything's experiencing inflation, not just these commodity products. So natural gas is still kind of on a little bit of an uptrend, I would say. Gold and silver still sucks. Oh my gosh. I just can't. You can't catch a break. You'd think that the high inflation would mean, yes, buy gold. Nope. Maybe because and it's not because the rates are going up either. So I probably just concerns about China might be the key driver here. Then you got copper. Copper's still kind of struggling too. And then Bitcoin's below 20K. Not doing anything too interesting yet, but they might go for it, man. Today, if there was a day to do it, there was a day to go for it, might be today. Okay. Now here we're going to get the producer price index. So hold on to your seats, folks. And I've decided I'm going to mess around with Sim here a little bit. Okay, so here's the news. And I am getting core PPI month over month lower than anticipated at spot 4 versus an expected spot 5, but the headline PPI 1.1 versus 0.8. So that's actually a little bit of a mixed bag. It's going to be curious to see how they sort this out. The S&P 500 has spiked both directions now. I think I want to manage maximum 5 contracts here. Didn't get filled on that one. Oh, this is an interesting thing. Hanging on for the ride. Yeah. I feel you, Bill, man. This market has just been so wild. It's just been so wild, right? Now Taleb is pointing out something interesting. Sharp actuary, the 1980s was a boom period primarily due to cheap oil. Was this simply due to the very high prices in oil prices in the 1970s? And Nassim Taleb says, voila, cheap oil / commodities bankrupted the Soviets / Russia, and it will do it again. I don't think he likes the Soviets. Yeah, news squawk. You need to turn your mic down a little bit. It's clipping. Wonder how you tell them? Maybe not. I don't think they do. Yeah, whatever. Okay, so we did have a little bit of a down move and a rebound up higher. S&P 500 at the moment looks like it's going higher. I have to say, even though the headline number was pretty high, and that just shows that energy prices are really impacting production costs. You know, it's a much better report than what we got yesterday, wasn't it? Much better report than what we got yesterday. So we'll see. I am concerned, like the whole thing I'm looking at here is that the 10-year is below 3% when we're basically saying that it's going to be 2.5 in a week. And then after that, they're probably going to put it up to 3.25. And you telling me that the 10-year is still going to stay at 3? No, that's something's not right there. There's some kinks here in the curve, and I think that they're going to have to come out. So I'm kind of on the lookout for that short. Okay. President Joe Biden said Thursday that the United States is not going to wait forever for Iran to rejoin a dormant nuclear deal. It is actually very curious. There were points where it seemed like they were really close, and I was like, "Why? Why are you doing this?" And now it's kind of like maybe they're finding out that it was a really bad deal. I don't know. Oh, what's this? I missed. Let's go. I'm going back down through my Twitter feed, see if there anything interesting was released overnight. Nick Timiros. I don't know. How do you actually say his name correctly, right? Richmond Fed President Tom Barkin. There is near-term recession risk, but I think the medium term is better if you have inflation under control. What? That seems a little... There's near-term recession risk? Dude, we're in a recession, probably. At this point, I think it's 70-30. We're in a recession right now. Don't worry about the view count or the live count. You are helping everyone that watches extremely. You were the sole reason I modified my strat. Really? Thank you so much, Fatos. Well, I don't really pay attention to the view count too much, simply because it never changes. It seems like no matter what I do, it always peaks at around 24 people. There's like a core group of people that watch, and then YouTube will push it out to X number of people, and it never changes. so I'm kind of like, I guess it's not worth concerning myself too much with. I want to grow the channel. I would really like the channel to be to a point where I was able to live off of the channel so that I could do that full time and spend more time making content for you guys. I think that would be great, but we're a long ways from that. I do think I have to say, the last it's almost been a year now. Last year, my focus has been almost entirely on trading these micro treasuries better, right? And we've gotten okay at it. I'd say we've gotten okay at it. I think there's still some kinks to work out. I was looking back at my stats. And I've been doing incredibly well, actually. In over the last month and a half, we're up 150, actually, believe it or not, which for micros is really, really good, right? But in that time, I also did experiments. Should we call them experiments? High risk kind of things outside of our core strategy, like trying to market make in the 5-year that have lost almost all of that. So, right. But I think we've gotten really good at it. And I think we have a framework here that I can confidently show to people and say, listen, if you want to learn how to trade, this is the way to start. And so I think going forward here, we want to kind of, we want to share that a little bit. Normally if you have a strategy that works, you don't want to tell the world about it, right? But number one, I'm not really necessarily sharing what strategy with you. I'm just sharing what the market actually is. You're still going to have to figure out how that works for you, and I'm pretty confident that I can do it better. But the other thing is that we need some liquidity in this market, man. We need to get something going here, and the 5-year is just silly. The lack of liquidity in the 5-year is really just quite absurd. So I think that we can fix that. That's what we're gonna do. And then when we have better liquidity, I would very much like to try and figure out some spread trades, do some swings with spreads. Sounds fun to me. What do you think? I don't know if right now is the best time for spread trades though, because we're kind of getting to the end. We're kind of getting to the point where you might see reversal, and you might see some strong steepening, but it's not enough to the point where I want to take that trade yet. So it's not time yet, but I'm researching, I'm reading lots of stuff. Also, I'm working. I really want to try and reduce costs for you guys, because I feel like you come in, you get the CME bundle, You spending $50 on your data, spend $50 on the live trade license for Jigsaw. Like, that's kind of, well, I think most of you guys probably end up going to a cheaper package anyways, right? But, uh, I think we can bring that down. I think we can bring that down and get more retail traders involved in trading rates. And I think that would be a good thing for everyone. So, but anyways, to the point, yeah, the live view count doesn't matter very much. It's going to be what's going to grow the channel is going to be our YouTube videos. So we need to do better on that. And that's kind of the direction I'm going at the moment. So they did have a bushel order. They didn't get to daily lows yet, but so far the flows that I'm seeing are somewhat in line with the one I want to see. There's a little bit more, back and forth than I would like to see per se. So let's just, one thing I need to do is I probably need to stay a little bit more vigilant, because the reason that we made the mistake yesterday was in part because I was, trying to quote unquote market make in the 5-year, and I wasn't paying attention and moving my order around. Right. It was one comment about how you've only seen strats really work when they involve volume in some way. I tried lots of different things and realized how noisy price really was. Yeah. Oh yeah, totally. Because it is like, there was a lot of research. There was a lot of people that had the theory that price was a random walk. Hold on. That's where I wanted to take some fills. Sorry, New Squawk was saying something. So there was a lot of people that thought that price was just a random walk. Now we've proven things about the behavior of markets that it's not just a random walk, but most of those empirical properties that I've learned about involve volume more than the price. So yeah, any kind of, like, we're talking technicals. I really don't like taking a trade purely based on technicals per se. At least not in outrights in treasuries or equity index futures. Might work on like spreads or trading the basis, or certain things to do with options, right? But generally speaking, when we're speculating in treasury outrights or equity index futures, we want to be, because we're informed traders and we have some idea of what the future volume is going to be, right? So I don't like taking a trade purely off of technicals, but the technicals that we do, the things that are going to kind of tell us how far it might go and what kind of the range of volatility is and things like that, that all comes down to watching the volume, not the price. And I guess watching how correlated price and volume are together, but it's still like you have to watch the volume, not the price. There's a big difference, isn't it? Well, oh yes, I was scrolling down in my Twitter feed. Did they not fill that? Oh no, they took 2. So yeah, trading order flow and volume for direction is a no-brainer compared to drawing trend lines and getting fake breakouts constantly. But seriously, Thanksgiving has changed. So wow, thank you so much. Price formed indicators or candles. Yeah. You know, candles is such an interesting thing because um here's what's weird about candles is in candles what do we call it? There's a name for this kind of bias. Um Anyways, the way that you do candles is you come in and you say, okay, here are all of the different candle price patterns that I want to trade. Which one works best, and then you trade the one that works best. And the one that works best on the past data is usually not the one that works best on the future data, right? So you're introduced data snooping. Sorry, that's what it is. There's a data snooping bias. So candles actually end up being good kind of entry signals for an algorithm because you get a really good distribution of traits. Like if you're trading some sort of momentum moving average crossover sort of a thing, one of the issues that you'll end up with is your algorithm will take a ton of tiny trades in an area and just chop around and lose money, right? You don't have that problem when you trade candlesticks because it's so evenly distributed. Is just that, as far as I can tell, the candlesticks don't actually provide any benefit. You could go through the 100 different candlestick strategies that are out there, and you test them over the last year, and you'll find that one of them worked really, really well. But then that's not the one that works well or is even profitable over the next year. You know, no instant conviction in a direction towards the numbers. It does look to me like the treasuries are set to decline today. We're still quite a ways above 118 even still. So let's consider that. But I do think that the fundamentals are on the side of the shorts here in the treasuries. That's my thinking for today. And I think that it being a day after the CPI news and just the huge discrepancy I'm seeing here between them pricing a full percentage point interest rate hike next week, the 10 year is going to have to sell off a little bit. Yeah, the 10-year is still under 3. Isn't that crazy? But I bet I'm almost 100% confident. I don't know, maybe we end up reversing today, so I don't know if today is really going to be like a super strong downtrend day. I'm kind of hoping that it's going to be a trend down day, to be honest. But at the very least, I think that they're going to touch 3% today in the 10-year. At the very least. Yeah. What's the green thermal in the top left? That is my Vista chart for the S&P 500. So the green, the brighter the green is, the larger the resting orders are. Yeah. I kind of, I actually wish there was more space. So, it wouldn't be enough just to have another window, right? I would need because I want my eyes to be here. I wish that I could put more things around my eyes because I kind of I'm interested rather in the spread here, right? So you see, if I open up the Vista chart for the 10-year, I don't have it set to the same template, so it ends up being gray instead of green. But you see the little black spot with the little white dots in it. That's the spread, right? And I'm interested in how the spread is changing, especially over in the 5-year. But I do it, I have this one up in here just because I think it's the coolest chart. In all honesty, we had a little bit of room after changing a couple of things, and I said, okay, we're gonna put the coolest looking thing we can up there, and so I put the Vista chart for ES. That's really what that was all about. Because again, It's not about like having enough room to put more stuff up there. It's about having enough room where my attention is like right here in this center part of the screen. Should probably reset the DOM. Does come through so far. I'm really happy with the way where I got my break even all the way to 17. That's pretty darned good. Good morning, Sheriff K. How are you? Is that really a picture of you? It looks like, oh, it's so tiny I can't really see, but it looks like it's a nice picture of you. You're wearing a tie. You know, always feel good about people in ties. Hmm. News Squawk says, if you survive the Twitter crash, we stand united together in the face of oppression. So apparently there was some sort of service disruption with Twitter, but I did not experience it. So I don't know what that's all about. Okay, they're going to come back up here a little bit. I think we can continue to play the range here, so I might do that. Yeah, you can plug Bookmap into TD Ameritrade. I think if we're honest, Jigsaw kind of stole the feature from Bookmap. Now, Bookmap has some other things that about their chart that kind of, I don't know, makes certain prices kind of like stand out differently. I'm not quite sure how they do it. But I find that really interesting. I don't know if it actually helps. The thing that kind of irks me is that when you're watching it trade, okay, like the thing that I want to see is like how much did it take for it to actually move compared to what was there, right? Because when I look at this chart, I can see here was a bubble, here was a price. Maybe there's a bubble there, and then I know that it traded. And if there's not a bubble, I can see that it went through. But like, what about all of the prices in between that? Right. I just have to look at what the cumulative delta is compared to the price movement to try and judge that. And, you know, I'm also looking for when it kind of starts to trade in a certain area because it appears that the liquidity is low in that area. So you're going to see a price where there's hardly anything on the bid. Like there's only like 50 on the bid. And it goes back and forth. It's doing that a little bit there, but I'm actually am seeing some stacks when it trades. So I wouldn't say that it's truly happening there at 12, but it happened for a little bit, right? And when that starts to happen, you often start to get a distribution around that. So that's one of the things that I'm really, really paying attention to, especially if I'm already in a position. And these Vista charts don't show me that. So yeah, they have the stop detector. It is pricey. Because not only do you have to pay them, but you have to pay for like the market by order data, which is like $100 a month. Man, I have to say, like, I think right now for you guys in the retail trading industry, I think that the thing that would help you out the most is reducing overhead costs. Like you got to be able to get full market depth data and everything, but you know, you're paying $50 for your platform and $50 for your data, right? They're making more money off of this than you are, right? I think that we can bring that in, and I think that something that's going on here is that a lot of the prices and business models and so forth that we have in the futures trading industry were based off of a world where to really do this truly practically, you'd want to be trading like tens of thousands of dollars or something like that, right? And now that we have micro futures, with micro treasury futures, man, you can start a $500 account and trade that for a while. You can probably last for a year on a $500 account if you're really careful. And so that's a completely different audience, and I think that we need to see pricing that fits that use case better now, right? But how we convince the vendors and the exchanges to kind of accommodate for that, I don't know, because right now it's kind of like, well, but look at the liquidity in the micro 10-year, right? It's terrible. Right? So how do you convince them that, oh, we'll make a different data tier for the retail traders? If you're only trading micro treasuries, then the CME fee is only $20 instead of, or is only $10 instead of $35 or something like that, right? Meanwhile, the cool products that are out, it's like you're paying $150 a month to be able to use. I'd rather just use TT at that point. Danny's view: inflation ups bets on 100 basis point rate hike. Our view: the S&P 500 sits on key support. I don't know why there isn't more concern, as inflation tops 9% and delivered its highest reading in more than 40 years. Well, I think the reason why the traders, should we call it, say just the traders, I think the reason that the markets overall are acting the way that they are surrounding this high inflation number is because over the last 2 or 3 weeks or so, all of the commodities have kind of taken a hit. So I think that they kind of are, maybe being lulled into a sense of false security because those prices are going the right way at the moment. I don't think that there is enough consideration to the possibility that all of those commodity prices spike right back up. Like those could all be right back up at their highs within a week, So let's see here. Michael Burry mad about Biden and the whole Saudi Arabia thing. Oh, Gary Norden has an article on his Substack. What's stopping you from becoming a good trader? Psychology or technique? We'll read that. Okay, and now I am caught up. What's Larry Summers? June CPI inflation hit 9.1% year over year. Housing has now become a key driver of inflation in the U.S. as predicted in February by my paper. As we predicted, shelter, which makes up 40% of core CPI, has been a transitory drag on inflation, but will likely rise from below 6% to above 7% in early 2023. Medical services inflation has also dragged inflation down, but looking at large nursing shortages, COVID burdens, deferred elective procedures, and financial problems of hospitals, we would expect medical inflation to accelerate. Note also that the reported inflation figures take a little, if any, account of quality degradation, whether it is long delivery times, canceled flights, stockouts in stores, or inept slow services in restaurants. These factors represent a kind of repressed inflation of a kind that is much more present in the US and other countries because of the far higher level of demand stimulus. Okay, so this is an excellent set of points that I think we can take a lot from, right? Larry is saying that the things that are really driving the high inflation at the moment, it's not really like food and commodity prices, right? And they're likely to be persistent. So we're probably still going to see more high inflation prints because the medical services thing isn't going to come down and the shelter thing isn't going to come down. right? It actually could be interesting because the things that people are pointing to as like commodity prices are coming down, it's like oil and wheat and stuff like that, right? So those are things that are reflected in the headline number and not the core number. So I think what we could start to see is the headline inflation number cool off, but the core inflation number will still be high, which is a problem because again, the core inflation is viewed as more consistent and predictive of what the Federal Reserve will have to do monetary policy wise. Oh, what's the bond desk saying here? Trading overreach into the trading desk. Regulatory overreach. Complaints about regulators expanding rules for equity markets into fixed income are rising on both sides of the Atlantic. Oh. This is pertinent to my interests. Shall we read? The Security and Exchange Commission in the US and European Securities Markets Authority have both proposed expanding the definition of trading venue. This has caused concern among all varieties of market participant as the definitions used are so broad as to require specific exemptions for telephone calls, because the majority of the fixed income market happens over the counter and through telephones. Among these complaints, buy-side trade associations argue that regulators risk interfering with the buy-side bond trading desk by classifying buy-side tools as trading venues. Behind this seems to be a misunderstanding about over-the-counter trading. Oh, now we got some good fills there on that. Return back to the lows. Feeling good. I would have liked to have another contract so that our break-even point is above the high of the day, but that's okay. While the proposed amendments reflect the Commission's focus on increasing regulatory consistency of platforms that facilitate electronic trading, they unfortunately risk sweeping in systems that perform what unmistakably is a different function: order and execution management systems used by investment advisors and other buy-side market participants. The original proposal, tabled in 2020, has been to make trading venues in the U.S. Treasuries market that function like de facto exchanges by using central limit order books to process trades subject to exchange rules. The main area of pushback was in the inclusion of an entirely new term by which the SEC thought to step into fixed income markets more broadly. The Commission is also proposing to amend Rule 3B16A1. Man, that is, it's 3B-16 Section A, Section 1. To change the reference to a system that brings together the orders to brings together buyer and sellers of securities using trading interest. The SEC wrote, unlike orders, non-firm trading interest typically does not interact with other non-firm trading interest without further action by potential counterparties. Rather, the potential counterparties submitting non-firm trading interests interact with each other through the use of communication protocols. In Europe, the consultation paper on the opinion on trading venue perimeter run by ESMA has likewise prompted concerned outcry from industry participants. Within its consultation paper, ESMA noted that the 2018 MiFID II rules includes the reception and transmission of orders in relation to one or more financial instruments and as an investment service activity. A clear distinction should be made between RTO and the operation of a trading venue where the EMS sends orders for execution directly to specific counterparties instead of trading venues, and here might be considered multilateral in nature and hence in scope of trading venue authorization. Okay, but then what would be the disadvantage of that being regulated in that way? What are you doing over the counter that you won't be able to do anymore that you're so mad about? The IA is concerned that these proposals, which could result in large numbers of execution management systems having to convert to multilateral trading facilities, risk negatively impacting client incomes and ultimately be counterproductive. So that sounds like that they think that would involve more Trading costs. It's so much fun when you're, trading a range with multiple orders and it's trending in your direction. I shouldn't talk. It's probably going to go the other way. Sorry, like my asthma kicked in there. It kind of tickled my throat with the water. Mm. La, 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 la. Oh. Yeah. Oh, man. Equity markets automated secondary trading on central limit order books, which have a fixed set of rules for automating which two orders transact based upon time, pricing, and sometimes the size of an order. Listed derivatives, futures, and options followed the equity model as they were listed by their exchange and their characteristics suited by the same workflow. By contrast, bonds are often not listed. Because, okay. Sorry, there was a little bit here that I skipped. Bond markets remained over-the-counter markets because bonds were often held purely for payment of interest and return of capital rather than as instruments in which capital gains might be realized. Barring a credit event at the bond issuer, they provide a more certain cash flow than equities. The buying and selling of any individual bond was less common than for a stock, exacerbated by the issuance of multiple bonds by any issuer, hundreds in the case of blue chip firms where one stock would be common. Okay. Why regulators are worried. The drive for the SEC to expand Reg ATS into the Treasury space was triggered by a liquidity failure during Q1 2020, led by the sell-off. In March of that year, concerns were raised that the Treasury market was effectively unsupervised as cash bond venues did not have the level of regulatory oversight expected of listed security venues. After an initial consultation in 2020 focused on treasuries, the SEC's expansion to include communication protocol systems for any type of security in the 2022 consultation came out of nowhere. Now that's interesting. So basically, when liquidity completely dried up in the treasury market in 2020, and we're like, this is like so messed up, this can't continue, the regulators were just as concerned about that as we were. So this might explain why some of the fixed income markets, though, are starting to become a little bit more electronic trading based, and there's this huge mad scramble for the exchanges like BrokerTech and TradeWeb to become, to build up their electronic trading systems. Although it's not to the point where like retail traders would have access to those markets. But what we're doing here in rates and creating more price visibility with on the run rates will probably play a significant role in all of that, though. So it is still going to be pertinent and interesting to us. ESMA had come at the issue from a different angle. It had been cut out by OTC equity trading in 2007 when it first introduced rules for off-exchange equity trading under MIFD, because brokers were able to offer unregulated venues that did not fit any of the defined criteria for regulated venues. In 2018, its MIFID 2 rules sought to capture any trading venues and expanded into non-equity trading. I see. So they're saying that because of those, what was in there, it allowed everybody to skirt the rules that they were trying to put in place. So that's why they were trying to expand it. That's funny. However, it now had a set of venue definitions that were designed for the equity market and were being applied to other asset classes. The tension between its existing definitions and OTC market trading models were made apparent when it established the organized trading facility category. The Organized Trading Facility Category Final Report, published its Q4 2021, noted the need to set perimeter around defining what was a trading venue and what was a non-trading venue software. In both cases, rather than define a venue, the regulators have sought to create catch-all terms so broad that they have had to create carve-outs for communications such as the telephone and chat, which would otherwise be in scope. Elizabeth Kirby, head of U.S. market structure at TradeWeb. This is an important person. I want to know this person. How do I not know this person? I feel embarrassed that I did not know that there is a head of market microstructure at TradeWeb. That's so cool. Head of market structure. Yay, we got the fill on the downside. Does that put us above it? Nope, not quite. Need a little bit more. Oh, Elizabeth hasn't posted lately. She liked something a week ago. Well, maybe like Twitter or something like that. Nope. Oh, no, wait. She does have a Twitter account. She does, but she doesn't really use it. That's okay. But you know what? The other thing is I don't think that I follow TradeWeb. I don't think that I follow TradeWeb on Twitter. Yeah, let's go and find TradeWeb. Hello. That was a pretty good break lower there, by the way. So I'm going to cancel that order way back up there, because if they were to come back up to that point, we must be in a very different market at that point. And what were we looking at when we came in here? 3.8. So let's just keep track of how much money I probably should have made today, but didn't because I'm switching brokers. $20 so far. Probably going to be another $50 day, I think. Okay, anyways. As proposed, the scope of what would count as an exchange could be interpreted quite expansively. The fact that the SEC found it necessary to clarify that utilities, i.e. phone companies or general-purpose electronic web chat providers, could not be covered exemplifies the potentially expansive universe of firms that could be captured by the rule. In Europe, ESMA delineated between general-purpose and communication systems, which it notes, despite such terms, systems allows for the possibility of being used for communication of trading interests. They are not governed by rules which facilitate such interaction of trading interests and other tools that could facilitate multilateral trading. The risk of such a report, as the IA noted, could be to hinder the use of technology that helps traders in OTC markets. Simple bilateral fixed connections on either OMS or EMS platforms between banks and the buy side are simply distinguishing trades that would otherwise take place over the phone. This reduces risks and errors and improves settlement procedures. The systems are not taking on the decisions whether a trade should take place. This ultimately still be done by the trader at the investment management firm. So that whole thing is just really interesting. I know that was probably like really boring for you guys, but like where the bond industry is going, that's our thing. That's what we want to be hearing about. Are you part of the data disenfranchised? What? I'm concerned now that as the treasuries continue to push down, that there's going to be some weakness in the equities markets. Okay. Shall we read Gary Norton's little Substack post? He's going to be touching on something that is like a real pet peeve of mine. So, psychology has become a hot topic in trading in recent years, with the driver possibly being the success of Mark Douglas's book, Trading in the Zone. Retail traders are often told that they are being held back by their mindset, and as a result, they are spending increasing time and money exploring this avenue. But while reviewing Anders Ericsson's book Peak for the Norton Method members, recently, one point in particular jumped out to me regarding the influence or otherwise mindset/psychology in success. Anders Ericsson is a world-renowned expert in how to achieve success. He has studied athletic, chess players, musicians, etc. over a decade. The now widely known idea of 10,000 practice hours is based on Ericsson's work. By the way, 10,000 hours is an average, and the real number can be less depending on a range of factors. I would encourage you to read Peak, as it truly sheds light on what it takes to become successful and contains more good ideas than I've ever had or read or heard from any trading psychologist. The following is a direct quote from Peak on one aspect of what it takes to move from being unsuccessful to success. Generally, the solution is not try harder, but try differently. It is a technique issue. Ericsson goes on to explain how the idea of willpower is also not true. There's no such thing as willpower. Ericsson explains that success across all disciplines is driven by process and practice, not by psychology or mindset. But there is such a thing as willpower, because there's been studies that have shown that people have a limited amount of willpower created by their the amount of chemicals available in their brain. But willpower itself is really like the result of multiple different processes in your brain working, right? Okay, I'll give them that. Maybe it's not, because willpower is not like a direct thing. It's kind of a couple of other things working together, right? So I'm looking at Edge Clear right now. So that would put me back at Phillips Capital for the FCM, which worked pretty good when they were the clearing for NinjaTrader. So I kind of felt like, yeah, let's go back to Phillips Capital, give the Edge Clear guys, they've put in a lot of work, and they've talked to me a lot, so I appreciate the relationship there, and I want to pay them back for the kindness they've shown me, and we can get back to having rhythmic data. But yeah, it's funny because as I'm saying that, there was tons of people that had problems with rhythmic yesterday. The way Rhythmic had issues yesterday, according to me, also on NQ and other people, around 2 p.m. data lagged timeout, probably. Oh, well, it was on NQ, no problem. But there was people complaining about CQG too. I think that the reality is that both Rhythmic and CQG are equally bad. Well, I shouldn't say bad. They're actually pretty darn good, but kind of for the level of quality that we want to have, which is like no problems ever happen ever. They're not there. Seems like to get that, you have to pay through the nose to get the data that is like flawless. But so which one is better, CQG or Rhythmic in that respect? I don't know. Hard to say. But I do like some of the features of Rhythmic better. So I want to go back to Rhythmic. CQG was lagging yesterday for like half an hour at the open. Yeah. And when we started out here, the micros were like not even updating. That might have been just my platform, but okay. I digress. Is psychology holding back my golf career? A few years ago, during an interview, I was asked about trading psychology and whether I thought this was an important area for retail traders to focus on. I answered by referring to my lack of success as a golfer. I am a recreational golfer. The lowest handicap I achieved was around 12, and I currently play off 17/18. Would an improved mindset or psychology help me become a golf pro or to lower my handicap? Of course not. To become a better golfer, I need to improve my swing and my game. I'll need to drive straighter and putt better. These are technique issues. Ask yourself this: if you had a great mindset and rubbish golf swing, could you become a great golfer? As Erickson said, it's a technique thing. You cannot become great at something without good skills / technique. Native CQG never lags, your platform does? Well, the continuum, yeah, that's the other issue, is that it might not be CQG, it might be continuum. You know what, though? When I was looking at the prices, Rhythmic is, or CQG is considerably cheaper than Rhythmic right now, is my understanding. If you're scalping, does it make a difference if you trade on Wi-Fi or hard connect? Yes. Okay, it very much does. So the problem that you're going to have with Wi-Fi is that Wi-Fi is a more lossy connection, which means that you'll send a packet and sometimes the packet doesn't get there. And then there's a certain amount of delay time that it waits where it says, oh, I haven't gotten an acknowledgement that that they received that packet, so I need to send it again, right? And that's where you'll get like a skip or a stutter. So if you were to say play Call of Duty on a wireless connection, even if it was a wireless N, you know, there can still be some packet loss. So if you were going to do it on Wi-Fi, I would make sure that you're definitely doing, you know, you're not just doing your wireless G, that you're using like a 5K Canon. And if you have to string a wire down the hall and tape it on the wall, I would do that. Okay. All right. It's technique stupid. For most retail traders, it isn't their mindset that is holding them back. It is their skill set. The majority use some form of technical analysis, which we know is extremely unreliable and has been failing traders for decades. I will follow up on the link between trading psychologists and technical analysis in a future newsletter. He's right. All of the psychologist people are pushing technical analysis too. If you use poor trading techniques, if you have no edge, if you have a lack of understanding of how markets work, then improving your psychology is unlikely to help you succeed. I read a post by a trading psychologist about a client who lost money on a trade after not sticking to their trade setup. In fact, many posts by psychologists are of similar situations. The solution, according to the psychologist, was to analyze why the trader did this with the typical self-sabotage type analysis. There was quite a complex psychological analysis. The trader would require a number of sessions to iron out these issues. I'm calling BS on this type of analysis. The solution isn't to be found in psychology, it is to be found in process. If you have a problem sticking to your rules, create a process, e.g. automation, outsource, execution, etc. to ensure that trade rules are followed. This is exactly how true professionals would solve an issue. Systematic and quantitative style traders have been doing this for decades. Another expert on success, Matthew Said, who has also written about the use and need for good processes. Successful organizations and business people build good processes. I would argue that many traders are using psychology as an excuse for their failure, and there is a growing and lucrative industry of people willing to indulge them. Again, most retail traders struggle because they use poor techniques and don't have the right skills and knowledge to succeed. I have worked with traders who struggle to take losses. This is often seen as a classic psychology issues, and in some ways I can understand that. However, the solution is almost always to carry a process, such as a stop loss order. While I do think he's right that when you have a problem that you want to set up a process, I do kind of feel though that this is Gary Norton. I do feel that psychology comes into play. I think that there's like you need to develop an understanding of markets, and once you have an understanding of markets, you need to be able to develop the psychology to be able to execute on that understanding very well. Because what I will find myself struggling with, and this is a problem due, because I'm ADHD, is that often you don't perform on what you know, or you don't follow the processes that you have set out when it's in the moment. And that is a psychology issue. The way to resolve that is not to connect with your inner child and all of these sorts of things. But it is an issue that you have to overcome. If you have ADHD, probably the way that you overcome that is you take medication, right? But being able to execute in the moment is a serious issue. And there's a strong body of evidence that suggests that, like, when you take a loser, your ability to make sound decisions is diminished, is significantly diminished, and you are more likely to lose in the future. And so you have to deal with that. I think that, yeah, you could use a process for that. I'm just kind of thinking the other side of it. It's like I do really like what he's kind of pointing out here, though, where he's saying that this kind of analysis of like you're self-sabotaging, I think is for the most part bullshit. Well, program it and get out of it then. Yeah, you know what? So, like, let's talk about our little kerfuffle yesterday. So, I had this account. I was drawing it down. So the thing is that since we've been doing this, actually, let's pull it up. So I had a loser in March, but like I came out of that and made way more than that. We don't have to pull out of that. I mean, I've just told you everything that there was to know about that side, right? So, but then I also did some trades in the 5-year and did some, I would kind of consider experimental trades on live that didn't work very well, right? So the majority of my losses come from that. So I've been kind of like drawing the account down, and, because the data fees just kill eventually. Like I just make back the data fee, and then you make a loss and it goes down. So I was kind of thinking that I was going to switch. I thought I was going to switch in August. So having to come in and maybe switching a little bit earlier than I thought, that definitely doesn't feel very good. And I definitely did not feel very good yesterday because of it. And I felt like my ability to work and, like I would needed to do some trainings, there's always like those necessary trainings you do at work and stuff. And I found it incredibly hard to focus. Like my brain was like, I felt like there was all this noise going a billion miles per hour going on in my head. And it was so hard to focus, right? Like that happened. And, but the thing that I think really hurts me about it isn't that it was a loss, right? That thinking seems like you're looking too narrowly. A genuine loser shouldn't affect you whatsoever. It does, though. It really does. And some people more than others. You after a loss, you tend to perform worse. This is just kind of a good general rule. And there's kind of like there's some like evolutionary psychology behind this. Like they did this study with crabs where the crabs would fight, and if a crab lost, he would be more likely to lose in the future, even against opponents that he had like beaten in the past and stuff. So there's like some sort of evolution psychology that has been developed in evolution that enforces hierarchies for some reason. Here's the S&P 500. Initial move is again a buy, but how many times have we seen that and then they fall down? I digress. I'm getting away from the point. See how ADHD I've been lately? It's probably because I'm not getting enough sleep. Even when I've taken my medication and stuff, I'm just so distracted. Also, I just really love responding to your comments because you guys say so many good things that I'm often more interested in talking about than the sentence that I was saying the moment before. But anyways, I don't think that what bothers me is that there was a loss. Okay, I've had bigger losses. I don't feel that loss says anything about the strategy or what we're doing or anything because the way that we've been trading and our understanding of markets is really, really good, and I'm quite proud of it. And we've been doing really, really well. Okay. And we'll have mistakes, but we need to work through those. And there's this whole thing like you can have fat tails and you don't want to have these fat left tails. And I do have those fat left tails in here, but those are not because of our understanding of markets, right? Those are kind of more personal issues that I have to work out, which would probably be like we should implement some processes and stuff. But I think at the moment that I probably shouldn't be messing with the 5-year is the conclusion that I come from all of that. Is that what I'm trying to do in the 5-year where the spread is way too wide and I try and bring it back in line with what this is right here? It can be done. It could be done, but I would probably need a much larger swath of money. And I kind of thought that, oh, well, I could just market make with one contract and eventually build it up and everything. But I think that I'm going to have to continue to do the building up over here in the 10-year. Right? That is a little devastating to me because I had this whole dream up in my mind that our efforts providing liquidity would cause improve the liquidity in these instruments and make them more popular and all of this sort of stuff. When I take that loss, now all of a sudden it kills a dream. Not because, listen, I didn't even have a tenth of the money that I have available to trade in that account. So that wasn't a problem at all. Okay. But it just kind of kills the dream. It says, that's not a viable strategy. That's not actually going to work. And that's kind of sad to me because that whole idea really excited me, So it is what it is. I don't think it's the same thing quite with psychology, but it's definitely had an effect on me yesterday. It doesn't look like it's having an effect on me today. Like I came in and I executed this thing today like a champ. I'm kind of pissed that I'm like not switching over because this would have been another $50 trade so far, right? 40 would have been 40. So I would be like way back up. Dude, improve the look. Well, we could do that. I mean, we're gonna put another 1,000 or so in. So I'm still only gonna trade it. I think that what I'm gonna do is I'm gonna say every $50 to $100 above the initial level that I put in that I get, that I'll allow myself another contract. So maybe now, like when we first put money in, I was still working out a lot of things, I think. And so I never really got the opportunity to really try sizing up, right? This market might give it to us. Next week, we might do it. Next week, we might be able to start doing some trades where we size up. Because especially if we're trading a move like this, right? If let's say that I'm on 2 contracts, I would already be able to put on a third, right? No, don't take it out of the CME. What do you mean by that? I have a chunk of cash that I just have saved up that haven't known what to do with, and I just kind of put it in there for, well, probably at some point we'll want to put more money into account, so that's when you use it. Not only that, but then also the amount of money that I originally set aside to trade the micros, I haven't used all that. So I don't want all of it in the exchange account for exactly the fact that you might screw it up. Woo, look at that. Do you see them bust through that 118? Ooh, mama. I'm a liking this thing so far. Like I'm sitting on 3 contracts and I'm kind of sitting to myself saying, well, at what point do I maybe take 1 or 2 of them off? Yeah, no, that's we're gonna keep doing that. No. So you don't understand. Okay, let me go back. The objective right now is to prove how effective you can be just trading micro treasury contracts. We've been so we kind of went through this interesting evolution, didn't we? So first, we were always kind of skeptical of technical analysis, but we were still doing a lot of programming and things like that. Okay. I kind of understood the main conclusions about the market, but not how we arrived at those conclusions empirically, because I hadn't read the research, but somebody that had read the research at a bank told me these sorts of things. So I kind of knew what I was looking for, but I didn't necessarily know why it was the case. And I think because of that, I was not as dedicated to as I should have been in terms of like what the right way to trade is and so forth. There's the dollar. Oh yeah, the dollar's at 108. What the fuck? That's a little crazy that the dollar is going so high, but I guess it's interest rates are going up here. The 6J is bouncing here a little bit, so we might get a reprieve in the treasuries for the moment. I will though take 1 contract off because I am a little bit concerned about the possibility of a liquidity hole developing at 118. No, it's the same trade. I wish I could put 5 treasury contracts on. Like the thing is from my experimentation with this so far in the 10-year, if I had like $20,000 to trade, I could probably do pretty okay in the 10-year. Of course, what I've been doing does have some fat tails, and I don't think I've ever experienced the fat left tail yet. So I wouldn't come in and say, but some when I'm doing it right, man, it just I smack it out of the park, don't I? I've just kind of learned it's like, listen, you just have to know which way the orders are going to go, and the treasuries love to trend. The treasuries love to trend. You can get just kind of like a little what do you call it? Double distribution day, right? And then every once in a while you get lucky and you get a trend day. I've kind of came in again. We'll go back to what we said earlier in the session. I'm kind of hoping that today will be a trend down day. I think that what we had yesterday was kind of a fluke based off of low liquidity, and I've noticed that for really, really big events, there is a tendency for them to make a really impulsive move, and then by the end of the day, like come right back to unchanged. It seems like there's this group of traders that know because of the liquidity that they can come in and smack it the other way. After a couple of wins, and if you can define risk, you can be doing 5 lots in a week. Maybe. The other thing is that I just was never built the account to where I really felt confident adding multiple contracts, right? So yeah, we went from this place where we kind of we weren't as I understood a lot of things and I could tell you a lot of things, but I didn't know how we arrived at those things, right? And then we went and we traded equity futures, right? And while we were trading the equity futures, we learned those things that help us understand why the market is the way that it is, and reinforced those conclusions that we had. And that gave me the confidence to really come in and be like, no, we don't mess with this. We focus on this. We don't mess with this. We focus on this. And I went hardcore into, I got to understand my market as well as possible, right? Then we come back to the treasuries. So in the treasuries was me having to sort out the different issues that arrive under that improved understanding and framework, right? I think we've done a pretty good job over the past year. I think that there's still some problems in there. One of the problems is that I really want to market make in the 5-year and it's just not working out. So I think that for the time being, we need to say only trades in the 10-year, right? Only trades in the 10-year. And I really need to be more conscious about when it's really not going to move. That's another problem that we have, is that I have had days where I tried taking multiple trades on a day where there wasn't really much reason for it to do anything. Okay. So we can work on those and we can deal with some issues. Some of that is just like having the experience and knowing, right? Now that we're to that point, it is my hope that we can build an account and trade multiple contracts. Because once we're regularly trading 2 contracts, then we could build this account really well, right? What I was doing before, it was just kind of treading water simply because what I was making off of one contract really only made up for the data and platform fees, right? That was the point that I was trying to get to, right? I don't know. You with me here? And the split side of that is that I really want to put effort into informing traders about the opportunity to trade micro treasuries. At what balance should one trade with multiple contracts? That's going to be up to you. I think that the reality, Bilgin, is that we're all over leveraged. I think that an ideal, how do I say this? In order for you to trade for the long run and give yourself the most consistency, I think that you want to limit your bad days to a 2% loss, right? And I think that most traders are leveraged up to the point that a bad day is at least 5 to 10%, if not 20% of their portfolio, right? So if we came in, let's keep the math even. If we had $1,000 account and we were trading one contract and we ate the whole up move yesterday in the 5-year, that'd be $100, right? That's 10%, too much. And we want it to be like no more than 2%. Then you're not going to take that with multiple contracts. But most days, a loss is going to be like $20, right? That's 2%. Okay. Well, then to really trade 2 contracts, you're probably going to want $2,000 at least, right? So I think I'm going to go into this with 1,500. Want to keep, some other stuff just in case we have some opportunity to purchase that comes along. So I'm going to put everything in it. And, so we'll still be pretty highly leveraged. Yeah. But a lot of it comes down to what you're comfortable with, because if the amount that you're trading is so much that just the amount alone kind of makes you nervous, then that kind of becomes a problem in and of itself, right? Okay, Cyrilax says you have to give Bitcoin some credit. It has been holding up well. Well, it has held up well. I'm not so sure that I give it like some credit. Like, I don't think that you give Bitcoin the credit for that one, right? Bitcoin is holding up because there are some actors in the Bitcoin space that are working their asses off to try and, isolate the damage. But Sam Bankman-Fried has basically been out there doing everything he can to try and save the Bitcoin market, right? So, and I think that there could be some players out there that are manipulating and so forth. But the reason why I say it that way, and the reason that I think you want to be vigilant on that, is that there is still a lot of risk involved in the Bitcoin market. We could still see large players blow out, and we could still see large moves lower. And it would not be very much. It would not be a very difficult thing to see another 50% decline in Bitcoin. It wouldn't take much, right? So, but it has held up. It has held up. My 2 cents, the better balances are the ones where the largest traders will need to cover on a breakout. Yeah. Well, again, it's when do I want to trade? I want to trade when I know that there is going to be a large meta order coming through. Somebody's going to come in. They're going to sell the treasuries because they know that the 10-year treasury interest rate is too low. If the Federal Reserve is really going to do a full 1-point rate increase in the July meeting and another 3/4 in September, like, we gonna have to go to at least 3.2, right? If that's the scenario, if the scenario was 1% and then 0.75% the next meeting, that would put the lower end of the federal funds rate at 3.2. The 10-year cannot be below the federal funds rate. That is just insanity. So that's why I was coming in looking for a strong trend down, right? Because I'm expecting a meta order. That's when I want to trade, right? Sometimes when you get a breakout, maybe that you can see those, but I'm usually looking for a more fundamental or like trading strategy base. And when I say trading strategy, or I shouldn't say trading strategy, I should say portfolio strategy. Like, basically, a certain kind of portfolio is required to do something under a certain circumstance, right? Like rebalance at the end of the month or whatever the deal is, right? That was a good explanation. Thank you. We've worked on that explanation a lot, live action, right? Like here's what happened is what I've really done here was, my whole story was, I talked to a block trader at Goldman Sachs, and they taught me some things that were really instrumental and really helped me avoid some of the biggest problems for traders. But they weren't able to go into the research enough in the short time that we had for me to really understand why all of those things was. And so what I've done is I've gone back and I said, oh, well, what would have been the best way to have taught me at that time? Well, what it would have been was to explain to me that markets are not informationally efficient. And why that is, because orders have an extreme impact on prices because of the mathematical nature of an order book. Orders have significant impact on price. And because of that, a totally random order that is large can move the market really, really far away from fundamental value. And that makes it, almost impossible for the current price to really, truly reflect all available information. So in order for us to predict markets, what we really have to be able to do is predict the orders, right? And there are large orders that get executed, and sometimes you can predict them. And so that's what we're trying to do. That's the explanation that I should have had, right? Probably would have saved me 2 years if I had had that explanation for the beginning. So that's why I'm giving it to you. And we were doing okay with it in equities when we were trying to do it with micros, but there's too much noise over there. So I moved back over to these micro treasuries where you have something that often doesn't move unless there's a good reason for it. And we've been doing pretty good with it so far. Seth makes mistakes. There's a difference between, this is a hard one because there's a lot of traders out there that where I say these guys, they take on too much risk and they don't realize that where they're deriving their profits from are from risk, right? So seems like they're doing really, really good. And then one day they just blow up, right? So how do you prove that the blow up was because of the nature of the strategy and how much risk you're taking on versus a psychological mistake fault on your part, right? Well, in this situation, the reason that we took the loss was because we were doing a trade that we don't normally do in another instrument that had nothing to do with the core strategy and was really more of an attempt to possibly do more of a market making strategy in a market that is very illiquid. Well, it didn't work very well. The way that market is moving, you can't do that. I think that we could work out a market making strategy would be something very, very different. Be something very, very different. And I think that the way that the 5-year is right now, that doesn't make much sense. If it was a calmer market, maybe we could try and play those things. If I understood more about spreads, then maybe we could do those things. But right now, no. So I think right now we need to keep our focus on the 10-year. And I got to do that for you guys because the thing that we want to do is we want to, alert more people to the opportunity that they can trade micro treasury yield futures. They can express an opinion on interest rates and hedge their larger portfolios. And in a way that has been very difficult for retail traders to do in the past. Okay, so which brings us to the question that, who was it that asked this? Faith, Focus, and Finance. What is the difference between the 10-year and ZN? Okay, so there's two differences that are really critical, okay? The first is that the 10-year treasury is has delivery, whereas the index futures are cash settled, okay? So by delivery, I mean that if you sell a futures contract and you hold it past the third day before the expiration month, so basically you have a short position in the expiration month, you could be called or assigned for delivery. And at that point, you would have to, give somebody, sell somebody $1 million in treasury bonds, right? So that's based on the delivery of the thing, and it's priced in, it's basically the price of the whole bond. It's $100,000 plus the amount. But it does this kind of weird thing because what they do is they say that we're going to assume that the yield was 4%. So what should the price be right now if the yield was 4%? And that's how they get the current price. But that's not really actually what you would, the bond that you would be getting, what the coupon on that bond would be. It wouldn't actually be 4%. So there's kind of all this weird math around that about when you want to convert between the cash treasuries and the futures. Okay, there's all this funky math for that. Okay. But that's the first thing. And I guess I could have just said that as simple as this is price, this is yields. Okay. The other difference between the ZN and the 10-year is that the ZN, there is a certain QSIPs. Sorry, I'm like clipping here a little bit. There are certain QSIPs that you could deliver. Okay. And there's going to be one QSIP that is going to be cheaper for you to deliver than the other ones. This is called the cheapest to deliver. Okay. It turns out that in the 10-year, that because of the basket that's in there, the cheapest to deliver treasury is not actually a 10-year treasury. Like, it is not a treasury that expires or matures in 2032. It's not. It actually ends up being more like 7. So the yield that you're actually would, if you were to convert this to yield, the yield that you're getting over here in ZN is really more like a 7-year yield, whereas the 10 is a true on the run 10-year yield. Okay, so that's the other difference. So that matters significantly for us trading the 10-year over here, because you might have some situations where the 10-year goes down really far, but the 30-year doesn't, because it's flattening. And so the micro yields over here don't move up very much, because they're a little bit more influenced by the 30-year than they are the 10-year, because it's the difference between a 7-year bond and a 10-year bond. And it seems like it should be a trivial difference, but it makes enough that, that could be like 10 ticks for you. Okay. So those are like the two biggest differences. Okay. Now that's kind of the whole thing, is that the treasuries are a very liquid instrument. Okay. But it's not directly tied to yields. And if you want all of these other funky things that you might want to be doing, that's based on the actual like interest rate per se, right? There's a little bit of math and stuff that you have to do to convert things over in the treasuries, and you're going to run into a situation where it doesn't completely bake itself out. So like you might want to like there might be a situation, you have a bond that you hold and you want to get rid of it and you want to hedge yourself with the treasuries, but the QSIP that you have might be different from like what the on the run one is. So how do you account for that difference? And sometimes with the granularity of the instrument, you can't completely account for that. There's going to be a little bit of a difference in between them that you just can't account for. And that's a risk or whatever, right? Or when you're doing spreads, right? You want to take the spreads as a flattener. There's a ratio, like how many 10 years should I trade to 30 years and so forth, right? Well, it constantly changes because it's never like completely on, right? But when we come over here and we trade the yields, we don't have to worry about that, because these are all sized the same, and it's purely the yield. So if I want to do a flattener based on the idea that the 2-year is going to come up above the 10-year or whatever it is, then all I have to do is sell the 10-year and buy the 2-year, right? And there's no other math or conversion or adjustments required. And then on top of that, they're really, really low risk. Rates don't move that much anyways. When they do move, the moves are a little bit more predictable. And so you end up with, as a retail trader, an instrument that is a little bit more reliable and less risky for you to trade. And it's a great opportunity if you want to learn how to trade to come in and do it. And if you're going to learn how to trade, I think this is the best place to start. And you come in, you're going to understand very quickly that you want to be an informed trader and that technical analysis doesn't work. The 10-year treasury will teach you that one real quickly. It'll teach you that one real quickly, right? So it really is a good opportunity. I think this is one of the best opportunities in trading, and retail traders are totally sleeping on it. Micro treasury yield futures. I understand futures trading involves substantial risk of loss and is not suitable for all investors, but here in the treasuries, you're talking about something that, it's $50 in day margin, $250, I think, to be able to hold it overnight. And like the biggest move that I've ever seen was basically 20 basis points would be $200. So is that's something that almost anybody could start a $500 account and start trading. And if I'm not going to say that they're going to make money from doing it. Probably you're going to lose money, especially if you're just starting out, because 95% of traders lose money, even if we've educated you as well as we can. That's just kind of the way that it works. But with $500 could last you a whole year of trading, as opposed to like in MES, you might blow that in a month, and then you want to keep learning, you have to put more money in, right? The 10s are not liquid anymore. Inside bid offer should be 4K by 4K. Yeah. Well, okay. So what would be the bar? Which is to say, so you think it should be 4K by 4K. What is it that we're able to do when there's 4K liquidity, or why is it that level would matter? The thing that I've noticed is that if liquidity is below 1,000, it's kind of a mess. It might be a good idea to just not trade it when the liquidity is under 1,000. Right now, it's questionable. I think that you can make money through here. They did revert quite a bit though, so it doesn't move. ZN moved 100 ticks. It wasn't 100 ticks, but we moved about 5 or 6 basis points this morning. Hold on, I need to crack my back. So I'm still hearing I think we're going to get new UK Prime Minister today, and it's probably going to be somebody that nobody in the US has ever heard of before. So the thing that's really interesting about the liquidity, though, is that this micro 10-year future here, the other ones maybe not so much, but the micro 10-year has basically improved the market. Believe it or not, the existence of this instrument has improved price discovery in the market, because the data on treasuries is not very good. Actually, you would think no, because isn't the 10-year like the most heavily traded instrument in the world? Well, that's the future, but the cash treasuries, a lot of that is done over the counter. And even if you go to the electronic markets and you look at the benchmark yields, there's actually a reasonable spread between the bid and offer on the yields. And then there is actually like a basis at the moment. There's like a whole 1 to 2 basis points difference between what the cash treasuries are yielding and what the micro treasury yields are yielding, right? So but to have a micro treasury yields come in and have a spread of 1,000th of a basis point has basically increased the accuracy of data about yields in the market. And as this goes along and we start to get multiple years of data and we start to get, more volume in these other ones, there's a real problem here with the 5-year where it's like there's only been 4 trades this whole session. 7 trades this whole session. So a lot of charting software, well, most charting software relies on there having been an order, there having been some volume to say what the price was. So if it's just the bid and ask moving around during that time period, you need a completely different way of doing the charting, which you kind of get with Vista, but in reality doesn't exist for retail trading platforms. So we need to get some more volume in there. But once we get some more volume in there and we have a few years worth of data, now we have all of this really high quality granular data about yields that did not exist before. And we will be able to learn from. We'll be able to do research on and learn things that we didn't know before. Isn't that interesting? we're all just thinking, this is just the CME is just throwing us a bone because, they didn't want people to start going to the small exchange, so they duplicated the products that they were doing at the small exchange. But the reality is that there is actually a very critical and important evolution going on in the treasury markets as we speak. Large exchanges, Tradeweb, broker tech, etc. The cash exchanges, they're becoming more electronic. It's changing. It's changing. And we here trading in the micro treasury futures are at the forefront of that change. And there's an opportunity for us to make money in being early in that market. The retail traders are totally sleeping on it. I want to seize this opportunity to say thank you for your contributions to trading. Just don't be too Americano-centric because you guys are standing on this ice. Let's put it that way. It's really, really difficult to be. This is a really weird thing. I don't completely understand why it is the way that it is, or how you overcome this limitation. But it is really difficult to be highly informed about what is going on in a country that you don't live in. Like, even if it's in Canada, unless you live in Canada, like the media that you get is different. It's hard to know what's going on in Canadian politics compared to American politics. How can I get access to granular cash market data for treasuries? Okay, well, so probably you can't. Actually, you can. I have some data through Refinitiv Icon. I have basically a trial of it, and they give me data from Tradeweb. If you had a Bloomberg terminal, that would be better. What I'm paying for that data is probably more than what I can make off of the data. So I don't think that it really makes sense for you to go out and get it. But maybe someday it will become more available to you. That only mattered in so much as when the spread was 100 ticks here, what should I put my bid at to bring it back in line? That's why I put it out there. That's why, again, I'm kind of like, I'm really devastated by this because I'm saying, because basically what we're saying is, Seth, you really shouldn't be putting one lots out like that. Well, then what did I get the data for? Maybe it was a waste. It's not a waste. At some point, we could write a robot. We'll continue working on that front. But that whole dream is a little disappointing to me. But maybe it's a good thing. Maybe it's a good thing because that's probably not where my interests should be focused. One of the things was I'm doing the Series 65. I need to study harder for that and get that out of the way because I don't think that that's really going to help the channel out too much and has kind of become a distraction. So I need to get that one out of the way as quickly as I can. You can still give it. Well, I don't want to say too much about how I got it because somebody gave me some good information and they don't want it out. But that's why I kind of say, like, you don't really want the data. You wouldn't get anything from it. I think you could, and statistically it's most likely to trade with that info, but yeah, it's super hard to actually execute it. Well, it's not just that poopy head face. Man, what a name. Because again, there is a basis difference between that cash yield and our micro treasury futures yield. There is a basis. So theoretically, I'm going to be keeping track of it. We're going to learn some interesting things here. But theoretically, that price should that basis difference should decrease as we get closer to the end of the month, and should basically be 0 at the end of the month. We'll see if it actually is. But that the basis is much wider than the spread that you're getting here in the 5 and 10 year. And, that basis fluctuates. So that kind of puts a big wrench in the whole, you just use that data over there to determine what you want to bid and offer, right? It's more complicated than that, because you essentially have to determine what basis you're going to use at the current time. And how do you determine that? I don't know. I wasn't expecting that. I thought that they would match really close. You get what I'm saying? Yeah, it will be interesting. And like I said, there's interesting stuff about yield curves. Like the thing that's weird to me about the yield curve, what we have, do you guys, how would you feel if we went into a really complicated study? We have an hour. We have 50 minutes. I think we could read it in 50 minutes. I don't know, though. You guys are asking enough questions. I think I would rather talk about that stuff. There's a paper about mean reverting behavior in the treasuries that I still don't completely understand. I want to understand a little bit better. How does one trade in the cash market? What are the costs to do so? Perhaps that explains the spread, because it sounds like an ARB. Oh, yeah. So essentially, if you wanted to trade those markets, you would want to get access to TradeWeb or BrokerTech. BrokerTech is like the largest. I think they have 60% of the cash market, and TradeWeb has like 20%. And there's like 3 or 4 other ones that have the rest. Okay. But generally speaking, access is only given to those markets for institutional traders, because you're talking about trading buckets of like $100,000 bonds at a time, or $1 million of bonds at a time. So it's not realistic for a retail trader to trade it, essentially. But the reason that I think the spread is as large as it is again, like we were reading in this story that we read a little bit earlier in the cast. You typically don't sell a bond. You buy the bond, and yeah, people trade it, but there's a really, really, really large portion, much higher than in other securities, of people that just hold it to the expiration, right? And so that means that the actual liquidity that exists in the cash market is actually not that high. The liquidity is actually not that good. And so where I thought that the spread in yields in those cash markets would be practically nothing, it's actually quite wide. It's basically, in many cases, wider than what we're seeing in the micro treasury yield futures. In other words, the goal of the micro treasury yield futures is to improve the price accuracy of benchmark yields, they've already accomplished it. The mere existence of them is more these yields that you're seeing here are most of the time more accurate than what you're seeing on the cash market, with the acknowledgement that there is a basis difference between them, and that sometimes the 5-year just like has no bids on it at all. Then you need to top it. What are you talking about, man? I'm having trouble figuring out, okay, So if there's mean reverting behavior in the treasury, what is the correct math and modeling that you do to observe that mean reverting behavior and then point out a good trade for it? The market is slicing through butter? Well, the ES came down pretty good, didn't it? The treasuries, after having that really good strong decline below 118, they have reverted back higher. So I kind of think that what might be going on here is that there is some large fund or whatever that has decided that they want to buy everything below 118. If your account was 2x of what it is now, would you increase or double your? Yeah, probably. I think so. I think that you can probably increase your lot size, um, even before you have 2x of, you know. But I digress. The problem again is you do want to avoid a far left tail. Is mean reversion a real thing? Well, so a data series that mean reverts is definitely a real thing. Which markets actually will display that kind of behavior? It's a little okay. Like there is a certain amount of statistical mean reversion in the equities space, but the equities space like trends so much that trying to make money off of that and mean reverting behavior is probably pointless. What I understand about the treasury market is that there's a mean reverting behavior, but that it is not strong enough to make sense as the sole source of a strategy for a large fund. But with the simplicity and everything else of micro treasury yield futures, that might make it worth it. So we'll see. For mean reversion isn't as simple as determining the correct mean function, usually some window, and then expecting reversion on a standard deviation greater than 2 and less than 3. I don't know how they're doing it in this study. That's why we need to read it. I have never read the very specifics of how they want to do it. But what you're saying is basically like use Bollinger Bands. And I'm just saying, I don't think I've ever actually backtested Bollinger Bands with stop out if it gets greater than 3. That's actually interesting. An interesting thought. It would have to be greater than 3 at the point at which you took the trade. But like I said, because the price, basically what is mean reversion, it should be based on the current price. So if you're going to run like a standard deviation sort of a thing, you could run a standard deviation on range, but not like deviation from the mean price. Doesn't work very well. Right. Man, I did something. My back is kind of out. I haven't been able to get it to go back in. But yes, I always thought that you do mean reversion like with Bollinger Bands, but we'll see how they're doing it. I don't actually know how they're doing it. Hmm. I'd rather use it judiciously. Well, Yeah, like I think that where it makes sense is kind of more okay, so here's the thing. Um the spreads exhibit long trends. Long time horizon trends, right? You will get a really steep increase in the yield curve um as we recover in a recession, and then ever after that it will just flatten through the whole bull market. And so you can see something that will flatten for several years. So you should be able to get into a situation where you can say, okay, the yield curve has steepened this much over the last week, even though the larger run trend is flattener. So here's where I want to try and put a flattener on, right? And of course, the fundamentals matter there, right? But like it kind of trends in that direction because the fundamentals stay the same for a long time. So that's why I think that a spread trade is attractive. It would provide a better basis for us to do market making off of, because you can set yourself up with trades that have very high probabilities, because the chances are the chances that we're actually in a period where the curve like completely, the trend in the curve completely changes is basically the chances of like, are we in a recession or not, right? Which right now is kind of questionable. Okay, I grant you that. But normally it's like, well, that's something that only happens once every 5 years, right? Spreads are dank. I wish. The thing that I find so weird about spreads is that there is information out there about spreads and trading a lot of talk about trading the yield curve, but all of the talk that I see about trading the yield curve tends to be more about the practical like execution aspects of taking a trade in multiple instruments or taking a trade in the exchange traded spread, and calculating the DVO ones and everything to see how close your spread is to the change that we're actually going to see in the yield curve and all of that sort of stuff, right? So essentially, all of the information out there about yield curve trading is information that we don't have to deal with because of the micro treasury yield futures. Right? With the micro treasury yield futures, it's so simple. Now all we have to worry about is, what trade do I make? When do I want to go short the yield curve or long the yield curve? Which tenors should I be taking it in? And at what point is it like an optimal situation to want to try and take a trade on the yield curve? And do I want this to be a swing trade or a scalp trade? I know that a lot of the activity that happens in the treasuries here is spreading. So those people that are like scalping with spreads, what are they using to determine when they want to scalp on the spread? That tells you, remember, what are the chances, and then it happens and everyone reacts to it. Yeah, well, it will be. It would be a trade where for a yield curve trade, it would be a trade with a fat tail. Essentially, it's going to work like 80% of the time, but that 20% of the time where it doesn't work, it can be really ugly. And so I've heard, so my mentor, may he rest in peace, John, he told me that a year or two before I came on the scene, so like 2015 or something like that, there was actually, no, not 20, because 2015 was, no, I came in 2016. So it was like 2014, 2015. There was an educator out there that had a whole room, a large room of people trading spreads. And I kind of want to know how they were doing it. And he said that one day the whole room blew up. Like he took a bad loss and everybody got creamed. So they didn't realize the fat-tailed nature of what they were doing. But if we understand the fat-tailed nature of what we're doing, and we can hedge for that risk, we can handle it, right? But there's just not enough information out there from what I can find about doing it. There is some, so the thing that I'm finding interesting is that I'm finding more information about basis trading than I am about yield curve trading. But I think that's because the whole basis thing is kind of a little bit simpler of a deal, right? Here's when it starts out, here's us, and here's us, and here's the cash, and then we'll tend to go up a little bit more than the cash, and then this will mean revert back down to what the cash is by the end of the month. So a graph of the actual change in the basis looks something like this. And that's all there is to it. Is just saying, okay, basis is too high, I'm going to short it now, based on this statistical measure of it being too high. Which we might be able to utilize that somewhat in the treasuries. Kind of the question is, okay, so are there behaviors that we will see in the outrights when there is an outlier in the basis? One thing that I am noticing, or one thing that I already have determined from yesterday, and is maybe kind of a duh thing, and maybe if Akshay is there, he can correct me if I'm wrong, but it seems to me that in periods of high volatility and uncertainty, news, low liquidity, etc., that the basis tends to increase. So that's your risk with basis trading. But what you would want to do with a basis trade then is to say, okay, like yesterday, the basis went from like one basis point to 2 basis points. So I want to go short it here when we're having this volatility because it will decrease going into the future. I think that's how you do that trade. And I think that yesterday might have been the time to take that trade too. I think in general they could protect themselves with highly liquid instruments and using stops. Is true a lot of pairs/spread traders don't use stops. Quants by Patterson and Quant Quake. Let's read. Let me go and find these books on one that I'm not familiar with. How a new breed. Oh, actually, I have heard about that one. But I want a book about yield curve spreads. That's what I want. Ahead of the curve, a common sense guide to forecasting business and market cycles. The yield curve, what is it really predicting? That's only $5. Analyzing and interpreting the yield curve, I have that one, but that one doesn't really tell me the thing that I wanted. We'll pull that book back up. Where is that one? What's this one? This is not. This one is in the wrong folder. This one should be in the yields folder. Oh, never mind. This one right here. Analyzing and Interpreting the Yield Curve, which was a good book. I don't think I got all the way through it. So then we're like, okay, basic primer on how you get the different kind of like models and yields and stuff. And then you come in and you say, okay, here's how, if I have like, here's the 10 and here's the 20, but I have a 15-year bond, how do I determine what the 15-year bond is? And there's all these different models of how you draw that line, essentially. Maybe there's has something to do with relative value, 279. Bond market participants take a keen interest in both cash and zero coupon spot yield curves. In markets where active zero coupon bond markets exist, such much analysis is undertaken into the relative spreads between derived and actual zero coupon yields. In this chapter, we review how yield curve analyses are used in the market with respect to bonds that are default free. Blah, blah, blah. Determinants. Mm-hmm. We kind of understand those things. The objective of much of the analysis that occurs in bond markets is to identify value and identify which individual securities should be purchased and which should be sold. At the overview level, this identification is a function of whether one thinks interest rates are going to rise or fall. At the local level, though, the analysis is more concerned with the specific sector of the yield curve, whether this will flatten or steepen, whether bonds of similar duration are trading at enough of a spread to warrant switching from one to the hold the boat. Oh. So it's like, at what point does it make sense to go from the 2 and 10 to the 2 and 30 or whatever the deal is? And that could change the flows, and we could predict that. That could be really useful. Okay. Remember that one. The difference in these approaches is one of identifying which stocks have absolute value and which have relative value. Trade decision based on expected direction of interest rates is based on assessing absolute value, whether interest rates themselves are too low or too high, which is what we're doing right now. I think that interest rates are too low. Yield curve analysis is more a matter of assessing relative value. On very rare occasions, this process is fairly straightforward. For example, if the 3-year bond is trading at 5.75 when 2-year yields are at 5.7 and 4-year yields are at 6.15, the 3-year bond appears to be overpriced. However, this is not really a real life situation. Instead, a trader might assess the relative value of a 3-year bond compared to a much shorter or longer dated instruments. That said, there is a considerable difference between comparing short-dated bond to other short-term securities and comparing, say, the 2-year bond to the 30-year bond. Although it looks like it on paper, the space along the x-axis should not be taken to imply that the smooth link between the 1-year and 5-year bonds is repeated from the 5-year out to the 30-year. It's also common for the very short-dated sector of the yield curve to behave independently of the long end. Yada, yada, yada. And then they get into all the DVO1 kind of nonsense. Right. Types of spreads. Well, there might be more that I can learn about that, but Inside the yield book. The economics of interest rate spreads and yield curves. Bond pricing and yield curve pricing. See, all of these books are like, you work at a bank in the fixed income. How do you do your job, right? But it doesn't really help in terms of like, I'm a speculator speculating on a change in the yield curve. Ain't gonna share that information. We might just have to discover it all ourselves. This is what I'm do. This is what I do when I'm off stream. Is I search Google for books about the yield curve. I've done this multiple times in the last month. I'm just kind of retracing my steps, in fact. And I did something to my neck. It just hurts right here. It's only started as I've been sitting here. Michael Saylor says, the world needs money that won't crash. Hashtag Bitcoin. And the street says Bitcoin is down 60% year to date. Squawkbot tweets, inflation is taking a serious toll on President Biden's economic approval rating. That's one of the biggest takeaways from the latest CNBC All-America Economic Survey. Charlie Biello. The market is now pricing an 83% probability of a 100 basis point hike at the FOMC meeting in 2 weeks, up from 0% a week ago. When was the last time the Fed hiked rates by 100 basis points in a single meeting? 1981. When was the last time inflation was above 9% in the US? 1981. Why was PPI lackluster? Are they calling it lackluster? I wouldn't call it lackluster. Mixed. It seemed mixed. I think that what you might see though is it might be the opposite of what we're seeing right now. Right now, you saw headline inflation high, core inflation, at least for producers, low. What you might see in the future is the core components continue to be high, but the headline actually comes down because maybe oil chills out a bit. China on the verge of violent debt jubilee as disgruntled homebuyers refuse to pay their mortgage. Ugh, wait, take the tragedy in Sri Lanka and multiply it by 10. The Fed just lobbed a financial nuke that will obliterate the global... Oh, geez, guys, come on. Here comes the violent summer of soaring dollar discontent. That's an accurate explanation. That's an accurate description of what's going on here. It is this soaring dollar is not too kind on the markets, is it? They say producer price inflation unexpectedly surges back near record highs in June. I don't know, man. We got a pretty good move down today. I don't know how you could call it lackluster. I mean, why didn't people react to it? Oh, is because they were expecting it, right? Well, but they did react to it, right? There was movement off of the news, and then after they sorted things out, we had a pretty solid trend lower in the 10-year treasury. I think that you are probably just spoiled from the volatility that we had yesterday, and you're expecting it to move 10 basis points again. So when it moves 5 basis points, you're like, oh, it's not moving. But 5 basis points in the course of 2 hours is a lot, okay? we don't normally get a 4 or 5 basis point trade every day. I've been getting them lately, and it's been really helped out my account, right? It was like we were really building a good it was good trading, dude. It was just, a couple of situations where it was really clear which way they were going to go, and they really moved. It kind of sucks that there was that reverse yesterday. I really need to be more on the alert for that sort of thing, because I so very often it's the big move, it's the piece of information that everybody is expecting, or is not expecting. It's the number that everybody is looking at, okay, and then it ends up surprising really big, and I'm like, that should be a trend day, and then it comes back. It happens to me all the time. And I need to remember that because of the liquidity and everything else, there's actually a really high probability of having that kind of mean reversion behavior where you don't really find out what the market thinks about it until a few days afterwards, right? This article that I had mentioned earlier from Zero Hedge, he's basically saying that when Volcker did it and he raised rates, there was a lot less debt, and there's going to be a really big problem from jacking rates when debt is what it is. Hmm. So I've heard this argument a lot. So I want to spitball here for a second. Why does how much debt that you have already out there matter for when you increase rates, right? If the government has already offered out X amount of debt, okay, then when the interest rate increases, the interest rate on that debt doesn't necessarily increase. Um, the coupon on the bond is still the same as it was. It only matters to the debt that you're going to be taking out in the future, right? So it's a big problem if you have a really huge budget deficit, for instance, right? Would you say it was a mass? Oh, 100%. There was no real liquidity on either side of that either way. So when somebody came in and took an opposite trade, it ended up moving it well past where we started at. This is the inverse sine law in action. Probably the best example you're ever going to get. I maybe, so remember when I was saying I'm worried about this hole at 118 and I took a contract off, and that was a really good decision. Since then, I haven't touched it. I could have maybe when we were up in this area. I don't think that we ever got to 05, did we? We got to 05. Actually, we got to 06 half. And maybe I could have added another contract on that, but I'm kind of happy sitting on 2 contracts and having my break even way up almost at 119, right? I think I will just keep it that way. Could you please give me two pairs of instruments that are highly correlated besides the indexes and the treasuries? Ooh, well, so the thing is that any future that you look at, there should be a companion instrument that you can look at that will have some degree of correlation with it, right? So for instance, if I'm going to trade gold, I want to look at silver. They don't match each other 100%. I'm definitely not in like degree of move. I've seen a lot of situations where like gold didn't really move much, but silver just got absolutely slaughtered, for instance. Okay. There's always going to be that companion, right? And it's just going to be the other instruments in that space. So if you're treating gold, then it's going to be the other instruments in the metals complex, especially precious metals. If you're trading wheat, then you're going to want to look at the other agricultural products like soybeans, right? If you're doing, yeah, Poopy Head Face says CL and BZ. BZ is the Brent crude contract, right? Sweet light crude versus Brent crude, right? And would that be 90% correlation? I think so. Kind of depends on like the time frame that you're putting on and stuff. But yeah, those would all be very highly correlated. Because I think that you're looking for something that's like, okay, this moved, so this should move, right? So I can do statistical arbitrage on it or whatever. Hmm. What's happening when price doesn't follow cumulative CVD? Yeah, well, so um, uh, if we're talking about equity indexes, because that's probably the place where I find that behavior the most common and the most confusing, is that you have to remember that these are derivatives and they're often trading against something else, right? So if I'm trading the equity index futures, for instance, there could be a situation where in the futures, these guys all buy up. So the guys in the futures, they want to buy it. But the index itself actually moves down for whatever reason it is. The index actually moves down. What happens is the market makers pull their liquidity and adjust their bid and ask based on what the cash index is. And so it moves down even though people were buying. That's kind of how you can have that sort of thing. So when you see a divergence between those two things, well, like for instance, if I'm seeing it in the treasuries, I see a move in the treasuries on very little volume or maybe even like opposite volume, I'm thinking there's probably a spread trade going on or something happened in the currencies that's moving us, right? Some correlated asset is moving. And yeah. Hmm. Hold on. Somebody's sending me something in a message, and I'm kind of thinking about what they're saying here. Nah. Hmm. Hmm. Mm. Well, you know what, guys? It's time for me to get going. I think I'm just going to end things a little bit early because I was talking to somebody when I think about this, and I haven't been really saying anything. But hey, tomorrow it's going to be interesting to see if they continue down tomorrow or not. It looks like they're having a really hard time getting below 118, so we'll see. But based on the current market pricing, I kind of think that this whole uh these price levels here in the treasuries are a little precarious. So it's going to be really, really interesting to see how it turns out. I will see you guys tomorrow. In the meantime,